Welcome to Retirement Protection Solutions Financial Planning Masterclass mini-series. This mini-series, or a very short video, is going to explore one product only and how we mitigate risk in retirement. We're going to look at structured notes on this particular video and see how they may or may not benefit you or part of your retirement plan. So let's get into it. Quick disclosure, if you'd like, pause your video and read through this. Okay, a quick introduction again. I'm Larry Spoth, president and founder of Retirement Protection Solutions. I am an investment advisor representative, and more importantly, we are bound by all fiduciary standards. Jacob Child is a managing partner at Retirement Protection Solutions, and he is also an investment advisor representative and also bound by all fiduciary standards and rules, meaning we have to provide by law what's best for you, what is in your best interest. So we like to teach people a little bit about these products because they may or may not fit your retirement plan. So today we're going to talk about structured notes, and we get those from our partners at Market Guard. Structured notes, this is part of the private wealth platform. Keep in mind, all of our investment portfolios, whether it's the dividend portfolio, the stock growth portfolio, the structured notes, everything we do with equities is going to be in the Charles Schwab custodial network. Okay, so we're going to be at Schwab, but Market Guard is going to be managing these products. All right. If you saw the full long video, the masterclass series, we talked about safe investments, or how to index with no market linked risk of loss. Those are guaranteed positions by insurance companies. We also talked about the dividend and growth stock portfolios in the long video. But today we're going to only focus on structured notes, how to mitigate your risk with returns from both an up and a down market. Yes, you can make money when the market is down, potentially, but there is risk involved, so we're going to look at that as well. All right, this is a hypothetical illustration of a dual direction buffered note, or what we call structured notes. This is how they work. The note itself will track, in this example, the S&P 500 index, the Russell 2000 index, and the NASDAQ 100 index. In this particular example, the note is a 2-year note, meaning if you choose to invest with this type of product, you're going to be in it for 2 years until the note matures. Okay, we also have 1-year notes, but in this example, we're going to show you the 2-year note. Participation rate can change. So every time that you're thinking of, maybe I want to use a structured note for some of my money that I don't need right now, I can let it sit there and grow potentially for 2 years. We're going to look at the 2-year note because it's uncapped. There's no caps on your earnings. I'm going to walk you through that. And there's this thing on the note called a buffer. In this case, it's a 20% buffer on the downside. So I'm going to teach you how that works as well. It's really quite simple and easy to explain. All right, let's hypothetically say that somebody came into this note and they bought the 2-year note. So you don't collect any earnings until the 2-year mark. So at the end of 2 years, when your note matures, or some people say expires, when that happens, that's where you're determined if you made any money or maybe even lost money. So anything that happens between today and the 2-year mark doesn't really matter. The index can go up, it can go down, it can chop sideways, it can do anything. What only matters is where it's at on the 2-year mark. So let's do this hypothetical. This note is going to track the NASDAQ 100, the Russell 2000, and the S&P 500. So let's say this is you, and you invested your money, and we're tracking these 3 indices, and at the 2-year mark, you get what the lesser of the 3 indexes produced. You get the lesser of the 3. So in this example, if the NASDAQ was up 35%, you earned 35%. So essentially at the 2-year mark, the note is over, so you get your return of principal less any fees charged. you get your return of principal and a 35% return. So you made 35%. Great. Now your money is in cash position and you can turn around and invest in something different, or you can buy another structured note and go another year or 2 years, whatever you like, because it's now back into a cash position. So that's great. You can make money when the market's up, but let's discover what this gray zone here is and what the minus 20% buffer means. So let's say at that 2-year mark, the lesser of the three, the NASDAQ, was down 10%, okay? You started here and the NASDAQ decreased over that 2-year period, and at the 2-year mark is down 10%. A negative 10% turns into a positive gain for you. You actually earned 10% when the market was down, okay? You earned 10, return of principal, plus the 10% return, minus any fees charged for the banking services, right? So you're up 10% even in a down market. What if the lower of the three was down 18%? Well, you got an 18% return. You got 18% gain. What if it was down 20%? You had a 20% gain. What if the lower of the three was down 5%? Again, you earn 5% added to your account, and at that 2-year mark, you get all the money. Well, the buffer, what it means is anything in this gray area, wherever the lower of the three indices lands, is essentially a gain. Your risk is if the underlying index goes below that 20% buffer mark. As an example, let's say at the end of 2 years, the market was horrible and the lower of the three was down 25%. You lose the difference. That's your risk right there. So the first 20% in the gray area, that's on them, not our problem. The difference, in this case, 5%, you would have a 5% loss. But let's think about that for a minute. Let's say you were in a regular portfolio and it was tracking the NASDAQ, just the old school NASDAQ portfolio, and it was down 25%. Well, you're down 25%. Versus over here, with the buffer, the first 20% was covered, you're only down 5%. Now, nobody likes to be down 5%, but if I was going to compare the two, what would I rather have? Be down 25% or only be down 5%? I can stomach 5%. Not happy, but I can stomach 5 versus my losing 25%. So anything beyond the buffer is your risk of loss. Anything in the buffer is a gain. Anything above your starting point is a gain as well. So pretty simple, really. This type of note might be appropriate for somebody that says, well, I've got my income taken care of. Larry and his company set up my income for retirement, and I have this other money, and some of this money I'm willing to put into a 2-year product. Maybe some of the other money is in a more liquid position because you got to plan for emergencies and unknown needs. So we don't want to put everything into one product. No. But let's say 200,000 was appropriate to move into this product. If the market's up, I get a gain. If the market's down and within this 20% buffer, I get a gain. If it's down below the 20% buffer, that's my risk of loss. Okay? So really quite simple to understand. It's appropriate for money that you don't need. You have other assets for unknown emergencies, etc. And you want to set this money aside and potentially make money in an up market or a down market. Pretty good. I personally like these a lot for some of our clients. So let's talk about the next steps and about retirement planning as a whole. So step one, when you come in or if you schedule with us, we first will give you a complimentary Morningstar analysis based on your current investments. So what is a Morningstar analysis? Morningstar, again, is a giant financial firm that is known for its analytics. It'll analyze what's going on, let's say in a mutual fund. What are the internal costs? How is this fund performing? Well, we can do the same thing with somebody's statement. Maybe you have a brokerage account or a 401k or something like this. We will send your statement up to Morningstar. So you have the true data of what your portfolio is doing sitting in front of you when we are doing financial planning. Maybe that Morningstar analysis exposes some weaknesses in your portfolio, maybe not, but it's nice to have that data from a third-party source. Step number 2, if we're going to build you a full legitimate retirement plan, again, net of tax tables, RMDs if you're over 73, inflation projections, we got all your other income sources in that retirement plan like pensions and Social Security, all of that's in this retirement plan. But in order to build that plan, we need to understand your goals and objectives. We need to understand your risk profile. We need to understand how much money do you need per month after tax? How much money do you need after tax? That's your goal. So we have to build to that and try to eliminate as much market risk as possible. We might even be able to guarantee some income with some of these different products that are available to us in the market. So what we try to do is teach people how some of these different programs work so we can stitch it all together and hopefully provide you with the best opportunity to have a very, very successful retirement. So once we do this and we build your retirement plan, we'll meet again and we'll drill down into that retirement plan, because we may build it the way we think is the best, but you might say, well, you know, Larry, I like that structured note thing that you showed me, but not interested. So we'll take that out and we'll readjust the plan until we get it the way you want it. And we'll test that plan in multiple different market scenarios so we can try to determine if it's going to cover you all the way through age 100. Okay. This retirement planning process is complementary to our webinar viewers that have investable assets of over 500,000. As you can see, some of our structures are, I like to say, cutting edge, but we have to have enough money to be able to allocate and get you to your goals. Now, sometimes we make exceptions to the $500,000 rule if it makes sense, if we really think we can be of value and meet our fiduciary standards with your case. All right. So we will either be calling you, since you set in your form field, we got your information, we'll give you a call. We'll have a short 10-minute chat on the phone. And if it makes sense, we'll put you on our schedule. Either Jacob or I will handle your retirement planning process, and we'll go from there. Thank you for watching the mini-series, and I hope you have a great week and a great retirement. Thank you.